Per usual, everything on this channel is for educational purposes only and is not intended as financial advice. It's Monday. Let's look at the macro side of things, starting with the flows report from James at CoinShares. Because of the ETH product launch, our 500 million inflows for BTC were not as large as they otherwise would have been because of the outflows from the Ethereum ETF, but hopefully going forward as a group in aggregate, we will see rising asset flows across the board. We certainly don't see that now. We still are dealing with ETH outflows probably for at least 2 more weeks, I'd imagine. I mean, we're still dealing with GBTC outflows 6 months later, 7 months later. ETH is a smaller product. Going into ETH launch, it was the same thing. There's people who are part of lawsuits that are selling, claims from lawsuits that are selling. Genesis, Grayscale, all these people are selling. And then there's just Joe Public switching products. Joe Public looking to go to a staking product, potentially. It's unfortunate for the ETH products that they aren't staked, at least not yet. But in any event, it should be bullish for ETH eventually. It's just a question of when and how long and what is that lag going to be. I think, unfortunately for the ETH people and the ETH people, they just don't care. You know, all they see is that they have an ETF. So positive flows of 520 for BTC, negative for 284 globally for ETH multi-asset. That would be things like GDLC, BitW, small positive, Solana, small negative, and nothing really else of note here. As far as the Bitcoin cumulative 30-day flows, we're still on the up and up here, and this is what we want to see. Just, it doesn't have to be a lot, right? We don't have to, again, we don't have to make the God candle every day. We can get denied at 70K 5 more times. That's fine. Eventually we win. Eventually the government runs out of coins to sell. Eventually the supply unlocks. At this current price, run out. Today we had the movement of Silk Road coins, Ross Ulbricht coins from the US government. The US government has collectively, I think, 15 billion in aggregate. It looks like they were splitting this off into custody. Probably eventually this will be sold. We chewed through Germany. We chewed through Gox coins. What's one more thing, right? At this point, it doesn't really matter. In the grand scheme of things, in the long term, it's obviously hypersensitive right now because we are at a key breakout level where news like this, regardless of the outcome of what's going on here, selling, not selling, whatever, people are going to sell it off on the news because that's just what the bots and the algos and the not so smart people do. Unlike the initial German onslaught of selling, this will be fully through OTC means and people who know what they're doing. So it won't be as impactful, most likely. Right before I started recording, Jason from CMR also put out a note about the Bitcoin positioning. For those unfamiliar, this is the Commitment of Traders report from the CME based on the futures data. It's aggregated into 3 buckets depending on who you are. Small speculators, so retail, large speculators, institutions, and then commercials, which would be the miners. Generally, we want to be on the side of commercials. We want to be on the opposite side of large speculators. And for crypto, small speculators never quite go negative, but ideally what you'd want to see is small spec also on the net short side or diminished. What we don't want is a massive small spec and large spec positioning on the long side. That generally means that's the wrong direction. We want to be on the opposite side of that. So his note said that based on the positioning here, not to expect much of anything. There isn't really a massive risk reward for this. Generally how this works in his system is he likes to see large spec massively short to go long or massively long to go short. And then as the large spec unwinds their positions, effectively a short squeeze, price goes higher. So here there's not really much fuel for a short squeeze. Commercials also not quite mega positively long as they were, you can see, into Q4 2023, into Q1 2024. This is the type of picture we want to see for maximum fuel. That doesn't mean we can't go higher. Doesn't mean it won't change this week. It just means as it stands as of last week, not to expect too much based on positioning. Before we go any further here, let me mention today's video sponsor, Kraken Prep. Kraken Pro is a complete overhaul of the Kraken trading experience with one-stop shop for advanced professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with the link in the description of this video. Not investment advice. Crypto trading involves risk of loss. Cryptocurrency services are provided to U.S. and U.S. territory customers by Payward Ventures Inc., PVI DBA, Kraken. Looking at the coins today on Kraken, it looks like the Asia session was very bullish. The US session didn't quite open as bullish, and then we had the GOX coins moving, and that sort of reversed everything. Overall, everything still looks very good. Sol, ETH, BTC, the majors still look great. ETH less so, but Sol still looks fine. Above the cloud, out of this potentially dangerous and devastating descending triangle, that Sol can thank Bitcoin for moving higher on that. It's good to see volumes on BTC higher than stables here today as well. And outside of the top three, it's really meme coins and kind of nothing else. BCH was up a lot randomly. And somebody had made a comment that the GOX selling is probably closer to done or done when we see BCH moving higher, just because those who received GOX BTC also received BCH. And if BCH is not moving lower, that probably means the selling is over, or it's just a highly manipulated price. But this is a good sign that suggests, at least up until this point, the BCH that's been received by GOX creditors has probably been sold. So unless this is Roger or somebody taking the other side of this trade, trying to make it look strong so people don't sell, I don't know. Just an interesting thing to think about. When it comes to macro and Bitcoin, I get a lot of questions about, like, why do I talk about what I talk about? Well, what does everything I talk about mean? And it's all sort of trying to get Bitcoin into context. Historically, in orange here, rates, US interest rates have been low or were zero. ZERP, NERP, those type of policies globally. There's always this question of what is Bitcoin? Is it tech? Is it a commodity? And then which bucket can we pigeonhole it in, give it some sort of allocation and call it a day? As we've gotten bigger, market cap wise, price wise, this is a chart since 2010, monthly candles. As we've gotten bigger, we've gotten more in the macro conversation. The macro doomers hate it when you tell them it's an inflation hedge. They say, look at XYZ, blah, blah, blah. Okay, fine. It's still going up and to the right. It's still done very well during monetary expansion. And it recovered post-COVID, I think, better than anything, better than any asset in 2020 into 2021. Eventually, as volatility settles down, we will still be pigeonholed into something, whether that's the emerging markets bucket or FX bucket or devaluation hedge, whatever. It's different things for different people. But all the data points we're looking at on these videos are trying to take a diagnostic of the health of the US economy, the global economy, the relative value between global economies, things like CPI, PCE, jobs data, the Fed, obviously, very important. But historically, we in crypto land didn't really need to care about the Fed because for most of Bitcoin's life, rates have been zero. So it's very impressive that we are at all-time highs with rates as high as they are. The next question everyone has is, okay, if rates come down, which it looks like they are going to come down in September, what happens? Is that bullish risk? Is it bullish equities? Is it bullish US equities? Is it bullish small caps? Have tech stocks hit a natural high? And then it goes back to the question, okay, if all those things are true, what is BTC? Is it a political Trump trade? Is it just another triple QQQ? Nobody really knows because it's everything and nothing all at the same time. It's its own thing. So it's very hard to pin this down. If anything, it's one of the purest expressions of a liquidity trade. As liquidity rises, as it will continue to rise, we will probably see a continual price increase in BTC with access and regulation. Price should continue to go higher. It's really that simple. People like to overcomplicate it, but that's really what we've seen going from retail to institutional over the past decade. So the whole point of all these videos is just to look at what could affect price in the near term on a week-to-week basis. Try to understand, are there any correlations with legacy or not? And what does it mean for price? It might not matter at all whatsoever, but people are always trying to label BTC, it's this thing, that thing, the other thing. It's not this, it's not that. It's not for me, it's too volatile. So it really comes down to the individual. What do you think it is? What do you want it to be? Because it tends to be something completely different for everybody. Looking at the economic calendar for the week, JPOW Wednesday, be there, be square, 2:30 p.m. Rates decision on 2 o'clock that day will probably be no change, but it will come down to what he says in the press conference as far as the jobs data that they will get that morning. We also get more jobs data on Friday. Because we are almost there with inflation, because we are almost there on the warning sign side of things with unemployment, there is certainly ammo for the Fed to back down. Now, if you look at various other metrics, GDP, which I'll get to, consumer spending, the higher end does not need rates to come down at all. It's the people paying the rates on credit cards, on mortgages, who desperately need rates to come down. The problem with that is that risks inflation perking back up once again. So it's certainly a difficult spot. Then there's the argument that the Fed doesn't really matter at all, and it's all about fiscal dominance and the amount of money we're spending. Certainly possible. We can't really A/B test that in the United States. But historically, once fiscal dominance takes over, not much else tends to matter. Looking at meeting probabilities, current meeting at 95% no cut, next meeting at 100% cut, where the question is whether it's going to be a 25 or a 50. Currently, the market is pricing in a 25. If we get a string of jobs data that triggers the Sahm rule, which would be this point of no return on unemployment, we will probably see meeting probabilities for September shift to a 50, especially if we get two successive jobs prints, one this Friday and one for next month for this month, that show unemployment rising quickly. Back to this idea of Powell's legacy and the election and all this other stuff. I doubt they're going to want to go slow on rates coming down if this recession risk is really picking up. And that's why the jobs numbers are so important this month and next month. If we get unemployment ratcheting down, expect the dollar to go higher, expect rate probabilities to shift towards higher for longer. But I don't think that's where most people expect unemployment to go. Looking at inflation, based on Truflation, we've made new lows, continuous lows here, down to 1.62 on the real-time estimate. Last month's CPI was 3.0%. This month's estimate for CPI also flat at 3.0%. So I've said this before, but it really depends on what Powell wants to use. What does the Fed care about on any given meeting or communication? Do they care about core? Do they care about PCE? Do they care about super core? Do they care about something else? But based on this, we are certainly there. We are beyond there as far as starting to bring rates back down. Now, rates don't need to go to zero, but it makes less sense to hold rates where they are if we are below the Fed's target. The UK, on the other hand, had a massive spike in the real-time estimates over the past couple days, and I dug into that as you can do on Truflation. It looks like utilities, natural gas, electricity, it looks like their energy costs have spiked in the UK. Not quite sure what's going on there, but based on the data gathered by Truflation, that's what that's showing. Globally, the easing cycle should continue. I think we have a ECB meeting on the 1st and in a couple days as well. So we should continue to see more easing across the board. As far as the next round of numbers, we're still not quite to the target across the board, but we're getting there. And it just depends on trajectory, rate of change, 3-month average versus 6-month average, depending on what you want to look at, depending on your assumptions about base effect and inflation rising again, housing inflation coming down. You could look at any one of those things and make any justification. It really depends what you want to say. But undeniably, CPI, PCE are down significantly over the past couple of years, with unemployment starting to tick up. We did recently get a PCE print. So I asked ChatGPT, just for clarity, the difference between CPI and PCE. And the TLDR here is PCE tends to be a broader, more dynamic basket, whereas CPI tends to be a little bit more fixed for urban consumers specifically. And I'll link this in the show notes. They treat housing a little different. The weightings are slightly different. The composition slightly different. Because they're both fairly the same thing, but the Fed prefers PCE over CPI, even though CPI tends to get most of the headlines from my experience. Looking at PCE from Nick at Wall Street Journal, this goes back to the point about what do we care about? This month's number, the past 6-month number, year over year change. We are still getting there. The challenge for the Fed and Powell is we are close enough to the target where we look like we're at the soft landing, but if they cut too much too soon, then inflation could re-accelerate. If they don't cut soon enough, unemployment could accelerate significantly. So they may have to thread the needle and split the difference there and just start to slowly cut at 25 basis points at a time. Looking at core PCE, also elevated, very noisy, but closer to the target. So what do they care about, right? Depends. Do they just care about unemployment more? Unemployment may be the talking point for this meeting because of the jobs numbers that we're going to get with the ADP payroll numbers and then unemployment after the meeting on Friday. If we look at PCE in the white, interest rates in the orange, and recessions in the green highlight, historically, PCE and rates tend to follow each other in direction, tend to be pretty correlated, let's say. And you can see PCE has come down significantly here, while rates still holding flat. I'm not rooting for one or the other. I'm just saying if the Fed is looking at the data, I think anybody would logically assume that, yeah, it's probably safe to begin cutting if your target is around 2%. Although they can have emergency meetings and emergency rate cuts and emergency liquidity infusions and all this other fun stuff, I don't think they want to do that. Now, Powell has said in the past that he'd rather over-tighten than under-tighten, and they were slow to raise rates. You can see PCE. What were they doing, right? I don't think history will look upon them with rose-colored glasses. Looking at PCE explode in 2020, where they were calling for transitory inflation, and the delay, the lag here for them to raise rates just made absolutely no sense. So they will probably be slow to cut as well, which is why the market is probably correct and we see a 25 basis point cut on next meeting. We also had a GDP print, 2.8%, fairly strong. We're spending a lot of money as a government. We should see some return on that. So the doomers are angered once again. Jimmy's rustled, definitely seeing a positive GDP print. They'll just argue, it's not real. Fine, whatever. I don't care. The Fed Now estimate, GDP Now estimate from the Atlanta Fed is also projecting around a 2.8 estimate next print on August 1st after the meeting. But the big things this week for sure to move markets are going to be the meeting on Wednesday as well as jobs on Friday. Look at the yield curve. The front end of the yield curve has started to sag. The belly has continued to sag. The long end kind of stuck in the mud here. And this will probably also change significantly after the meeting, especially if Powell gives any forward guidance on cuts into September. I highly doubt he'll come out swinging hawkish based on the jobs numbers, based on PCE, based on PCI. Highly doubt it. But if he does, markets are not going to like that. DXY should move higher, Bitcoin lower. Looking at the inversion in the yield curve in the white there, this is the next thing to deal with. We will likely get some sort of recession based on the metrics. Then what? What happens with unemployment? How low do rates go? And back to this initial chart for BTC. BTC's only lived through one recession, and that was a blip. That was COVID. If you dial this back to pre-2020, there were interpretations for an upcoming recession without COVID. COVID accelerated it, and then we got the V-shaped recovery thanks to liquidity and all the money printing. But you'll notice here when rates came down, so did BTC. That's why we go back to this where, okay, now what's going to happen? Are we going to see a range move down to 60K or lower if rates come down? Is there going to be this broad assumption that we are headed for a recession? We'll see. I don't know. It's hard to say. It's just another hurdle to get through past the election, more uncertainty to think about into November. But into Q4, into 2025, deep into Q4, we should be fairly in the clear with assumptions one way or the other in understanding what's going on with Bitcoin relative to potential recession. I still think TLT is one of the better looking charts out there. I'm a bond noob. Okay, so take this with a grain of salt. But historically, rates down plus recession has meant a jump higher in TLT. We'll see if we get the bull steepener, bear steepener, Trump steepener, bear flattener, whatever they want to call it. I just like the technicals. And I think it's lining up at an interesting place for TLT to move higher despite issuance concerns we have in the long run. Something to watch if you're playing the home game. DXY still ranging in the weekly cloud. High time frames don't really tell you anything. There's no trend here. It hasn't been trending since 2022. If rates come down, this is something to watch. If Powell is hawkish, Dixie goes higher or flat. If Powell is dovish, Dixie probably goes lower. He probably comes out and says a bunch of nothing, classic Powell. But if for whatever reason he's more dovish than the market is expecting, dollar strength probably declines. And as always, there's this sweet spot where we need a weak dollar, but we don't want a recession. We need a weak dollar, but we don't want unemployment going to infinity, at least for BTC. So it's just a matter of what degree of DXY weakness do we see. We certainly don't want what we saw in 2022, which is DXY just going to infinity because rates were going higher quickly. So I think it's fair to assume here, if we get a dovish FOMC, DXY spills lower, which would be great on a technical basis. Cloud breakdown here would be huge for the DXY. Oil's another one where I don't know if at this point you could really call this a massive head and shoulders or not. It's just funny the way it's panned out here. Clearly it's at some sort of huge multi-year support. It is leaning bearish. It is leaning like it'll go lower. If we get this global recession, we probably see oil continue to tick lower. So I wouldn't want to be long oil here, but this could be another Harris-Trump trade to think about, but it's not something I'd want to be long at the moment. The cloud likes the long side into 2025 if prices stay flat, but this support is definitely something to watch in Q4 if we get an official yield curve uninversion. As far as the indices, something else to watch, outside of random selling from the US government or whoever, would be how bearish do we get? And back to this thing of, okay, what are we? What are you, BTC? What are you? To some people, we're just another risk stonk. And if risk is selling off for whatever reason, what does BTC do in the face of that? If we get a full-blown Kijun mean reversion here on the S&P to 487, I can't imagine Bitcoin would be happy with that. I can't imagine. We have some degree of freedom here, down to like 520. But if everything gets turbo bearish, we will probably get swept up in that. Most likely. The good news is, after the dust clears, we will recover likely better than everything else, but it's eating that initial burst of pain where you have to be careful. Q's the same, also risk a full-blown mean inversion here to 423. Less of a percentage move than the SPY, but just looking at everything broadly, Mag 7, software, semis, just every sector you can imagine, nothing looks great. Not necessarily bearish, it just feels like most of the move. Look at this move since May 2023. It's really just been up only. 2020 and 2021 were similar, where we just kept Tenkan bouncing over and over and over. So this could just be another Tenkan bounce. But I think it's a good time to pause here, wait to see what happens, wait to see what happens with rates, the dollar, jobs, and then make the move. Still a little too much uncertainty, probably, for the market to break out. IWM also has this TKC clamp. It looks okay. It also just looks like the move, at least in the near term, needs some time to go sideways. DJI, kind of the same thing. It looks okay. It just doesn't look like an entry or a trade most people would want to jump into at this point in time. So there's certainly some mean reversion stuff across the board. And then we've got the most traded stock right now, NVIDIA, also rolling over. It started as a head and shoulders, then Pelosi came in and bought and it went up. And now it's got this M double top. The cloud is also giving you warning signals on a TK cross rollover, maybe a move into the cloud on the lower side here. But it's just not the time to go long on this. It just isn't. I don't think it's a great short either, per se. You'd want a bearish TK cross here, but the best longs are always going to be the same. They're always the same for the cloud. Bullish TK cross, price above cloud. That's what you want to see. And then you always want to see confirmation above the horizontal resistance. Is this a falling wedge? I like sub 100 or thereabouts eventually. It just looks like a whole lot of chop and a whole lot of people trapped up here. So while we're in the summer sideways, thought I'd recommend, I really like the Blockworks stuff. Not necessarily that I agree with everything everybody says on these podcasts, but very interesting content. There was one recently about the stealth QE with issuance on the short end by Yellen. Very interesting to listen to that. Activist treasury issuance, as they called it. I'll put the links to these in the show notes. Lynn Alden, I'll listen to anything she says any day of the week. She was talking about the rise of fiscal dominance. And then this last one, I don't know Tommy Thornton. I'm sure he's a nice guy, but listening to him just on a meta level is the exact opposite of what I want to be doing, what anybody should want to be doing. You should pick up on it pretty quickly, but one of the worst interviews I've heard in a long, long time. A long, long time. Not because he's short stuff or he's long energy. I don't care about that. It's just the way he talks about things. He's sort of mixing in technicals. Seems kind of clueless. Very curious on his multi-year performance. He says he's underperforming the S&P. Fine, whatever. This year. Just very funny on what he tends to focus on. So that's mainly for entertainment. Anyways, that's all I got for this one. Like, dislike, comment, share, subscribe. And happy trading.